You have a credit card in your wallet. You think you are spending your own money? You are not. You are spending the bank's money. And the bank is charging you for the privilege of spending it. Most people do not fully understand what is happening every single time they tap that card. By the end of this video, you will. What is a credit card? Let us start from the very beginning. When you use a debit card, you are spending your own money. Money that is already in your account. Simple, straightforward. When you use a credit card, you are borrowing money from the bank. The bank pays the merchant immediately on your behalf. You pay the bank back later. Every single time you swipe a credit card, you are taking a small loan from the bank. The bank gives you a credit limit. This is the maximum amount they will lend you. It could be 500. It could be 5,000. It could be 50,000. Depends on your income and credit history. At the end of each month, you receive a bill. This bill shows everything you spent on the card during that month. You have two choices. Choice 1, pay the full amount. You owe nothing extra. No interest, no fees. You use the bank's money for free for up to 30 days. Choice 2, pay only the minimum payment. This is where everything changes. The minimum payment trap. This is the most dangerous thing about credit cards, and the thing the bank hopes you never fully understand. When you pay only the minimum payment, the remaining balance does not disappear. It stays on your card, and the bank starts charging you interest on that remaining balance. Credit card interest rates are not like regular loan interest rates. They are much, much higher. The average credit card interest rate globally is between 20 and 30% per year. Let us put that in real numbers. You spend $1,000 on your credit card. You pay only the minimum payment each month. At 25% interest, after 1 year, you have paid hundreds in interest and you still owe most of the original $1,000. You are paying for things you already bought and already used. Months later, sometimes years later, this is called revolving credit. Your balance revolves. It carries forward month after month, growing with interest every single time. The bank designed this system very deliberately. The minimum payment is calculated to keep you in debt for as long as possible, paying maximum interest for maximum time. How credit card interest actually works. Most people think interest is simple. It is not. Credit card interest is calculated daily, not monthly, not yearly. Every single day, here is how it works. Your annual interest rate is 24%. Divide that by 365 days. Your daily interest rate is approximately 0.066% per day. That sounds tiny, it is not. On a balance of $2,000, you are being charged approximately $130 every single day in interest. That is $40 per month. That is $480 per year. On a balance you may have already spent and forgotten about. And here's the part that makes it even worse. Interest compounds. The interest you owe gets added to your balance. Then you pay interest on the interest. Your debt grows even when you are not spending anything new. This is compound interest working against you. The same force that makes investments grow over time works in reverse when you are in debt. The longer you carry a balance, the faster it grows. What is a credit score? Every time you use credit, someone is watching and keeping score. Your credit score is a number, usually between 300 and 850, that represents how trustworthy you are as a borrower. Lenders use this number to decide whether to give you a loan and at what interest rate. High credit score. You are seen as low risk. Banks offer you better rates. Lower interest on mortgages, lower interest on car loans, more credit available to you. Low credit score. You are seen as high risk. Banks charge you higher rates. Sometimes they refuse to lend to you at all. Your credit score is affected by many things. Payment history. Do you pay your bills on time? This is the most important factor. Late payments hurt your score significantly. Credit utilization. How much of your available credit are you using? Using more than 30% of your credit limit can hurt your score. Length of credit history. How long have you had credit accounts? Longer is generally better. New credit applications. Every time you apply for new credit, it creates a hard inquiry on your file. Too many in a short time hurts your score. Types of credit. Having a mix of credit types, cards, loans, mortgages, can help your score. Your credit score follows you everywhere. It affects your ability to rent a home, get a phone contract, sometimes even get a job. The hidden fees nobody talks about. The interest rate is not the only way credit card companies make money from you. Annual fees. Many credit cards charge you simply for having the card. Even if you never use it, late payment fees. Miss a payment deadline by even 1 day, the bank charges you a fee and may increase your interest rate permanently. Foreign transaction fees. Use your card abroad and the bank charges extra, usually 2 to 3% of every transaction. Cash advance fees. Take cash out using your credit card. You pay a fee immediately. And cash advances usually have higher interest rates than regular purchases. And interest starts immediately, no grace period. Balance transfer fees. Move debt from one card to another. Fee charged. Usually 3 to 5% of the amount transferred. Over limit fees. Spend beyond your credit limit. Fee charged. Some banks allow you to go over your limit. They just charge you for it. The credit card company earns money every single time you make a mistake. Their revenue depends on your confusion. Their profits grow when you do not understand the system. How credit card companies actually make money. Credit card companies have 3 main income streams. First, interest charges. When you carry a balance and pay interest, the bank profits. This is their most profitable revenue source. Second, merchant fees. Every time you tap your card at a shop, the shop pays the card company a fee, usually between 1 and 3% of the transaction. You never see this fee, but every business pays it and passes the cost to you through slightly higher prices. Third, fees and penalties. Annual fees, late fees, foreign transaction fees, all profit for the card company. Here is something most people never realize. The credit card company wants you to spend as much as possible. More spending means more merchant fees, even if you pay in full every month. And if you carry a balance, they make even more. The rewards points, the cashback, the travel miles, the sign-up bonuses. These are not gifts. These are marketing tools designed to encourage you to spend more and to keep you loyal to one card over another. Credit cards can actually help you. After everything we have covered, you might think credit cards are purely evil. They are not. Used correctly, a credit card is one of the most powerful financial tools available to you. Purchase protection. Many credit cards provide insurance on things you buy. Your phone gets stolen, some cards cover it. A flight gets canceled, some cards refund you. Fraud protection. If someone steals your card details and spends on your account, you are generally not liable. Your money is protected in a way that cash never is. Building credit history. Using a credit card responsibly, spending within your means and paying in full every month builds your credit score over time. This opens doors to better mortgage rates and better loan terms in the future. Interest-free period. Between your purchase and your payment due date, you are using the bank's money completely free. Up to 56 days in some cases. If you pay in full, you never pay a penny in interest. Rewards and cashback. If you spend money you were going to spend anyway and pay it off in full, you can earn genuine rewards at no cost. The key phrase is pay in full. Every single month. Without exception. How to use credit cards without getting trapped. Here is the simple framework that separates people who benefit from credit cards from people who are destroyed by them. Rule 1. Never spend more than you can pay in full at the end of the month. Treat your credit card exactly like a debit card. If you do not have the money in your account right now, do not put it on the credit card. The credit limit is not extra money. It is a loan with a very high interest rate waiting to activate. Rule 2. Pay the full statement balance every single month, not the minimum payment. The full amount. Set up a direct debit if necessary so you never miss it. Rule 3. Never use a credit card for cash advances, ever. The fees and interest make it one of the most expensive ways to access money. Rule 4. Keep your credit utilization below 30%. If your credit limit is $1,000, try not to have more than $300 on the card at any time. This protects your credit score. Rule 5. Do not apply for credit you do not need. Every application leaves a mark on your credit file. Multiple applications in a short period signal desperation to lenders. Rule 6. Check your statement every single month. Fraudulent charges happen. Errors happen. The only way to catch them is to read your statement carefully. Credit cards are not the enemy. Misunderstanding credit cards is the enemy. Let us bring everything together. A credit card is a short-term loan from the bank, used every time you make a purchase. If you pay the full balance monthly, you pay 0 interest. If you carry a balance, Compound interest works powerfully against you at rates of 20 to 30% per year. Credit card companies profit from your interest payments, merchant fees, and penalties. The minimum payment is designed to keep you in debt as long as possible.
Your credit score determines your financial options for decades. Used correctly, a credit card builds your credit history, protects your purchases, and earns you rewards at no cost. Used incorrectly, and it is one of the fastest paths to financial difficulty available to an ordinary person. Understand the system. Use it to your advantage. Never let it use you. This is not financial advice. Please consult a qualified financial professional. Check out other Broke Monkey videos for more financial topics explained simply. If you want to support this channel so we can keep making these videos, check out the link below. Apes Together Strong.